Good morning, Size Traders. Amos here with Gary, head trader at SizeTrade.com. I'm also here with Robert. Robert's one of our longtime members, and he called in with some questions he had about the markets. Gary, you here? Robert, you here?
Hey, good morning.
Hey, Gary.
Good morning, Robert here.
Hey, Robert. Robert, go ahead.
Yeah, I wanted to. Good morning, Amos and Robert. I wanted to ask, Gary. I wanted to ask Gary about what his take is on the markets. We're watching the Dow Jones Industrial Average, the S&P, and also the Nasdaq Composite. All three had a very good day yesterday on Tuesday, and I think the S&P hit a new high. We're looking at the volumes, which seem pretty substantial, about 2.25 billion traded on the S&P, and the Dow Jones also had substantial trading of about 400 or 500 million shares. So, are we now looking at the final stages of the late exuberance of a very long running bull market? Or does Gary think that this is the final stages? Or are we having the Trump effect, which might be a month or 2 months? Or is there a substantial reason, or are there substantial reasons for the markets to continue in this upward trend? And just what Gary's take is on all of this.
Hey, Robert. Yeah, no, so that's a great question. I think you have to take a look at all three markets, even though they trade together, including the Russell, and kind of separate them now. That's typically what happens in the later stages of a bull market. So each one has an independent reason for going up. I like if I had to pick a sector that I like the most, I kind of like the small caps in the Russell and the S&P 500 better than I do the Nasdaq. And the reason why is, well, Nasdaq we obviously know is technology based, but they're also biopharma based, biotech based, and with there's a lot of kind of problems going around with biotechs with the pricing of drugs. Both Republicans and Democrats, including Trump, have tweeted or talked about it. I think it's something that they could all get behind. I think people don't want higher priced drugs. It's something that's there's nobody out there who's kind of gonna take the other side other than pharmaceutical lobbyists. And in previous administrations, lobbyists, I believe, had probably a stronger say. So when you take a look at Nasdaq, you gotta assume that you're gonna get a negative from the biotechs. From technology, I think you're going to see a lot of positives from tax reform because they will benefit the most from tax reform because they don't get the advantages of other industrials. Like General Electric just announced earnings. I think their effective tax rate was like in the teens, 14, 15%. They're able to take a lot of subsidies into account. There are a lot of write-offs into account because they have huge factories and so on. With tech companies, they're typically one building like Facebook or so, and some employees, there's not so much that they can deduct, so they'll take definitely benefit more from the tax rate going down, the effective tax rate going down. Also, a lot of these tech companies have huge amounts of cash overseas, so repatriation would help them more. Those are the positives. The negatives that I see with the Nasdaq, not that I think it might go down, but might underperform the other markets, is that they're trading at a higher multiple. When there has been growth to be had in this market, it's been from the technology companies. Obviously, FANG became very popular, which I believe is Facebook, Alphabet, which is Google. I don't even remember what N was, but G was Google. Well, no, sorry, Facebook, Amazon, and I don't remember G was Google. And basically, those stocks led the market for the last year or two. They're the only reasons why the market was flat. If it was flat, which for the last 2 years or so, that was the only reason I think we might have been even actually down like a percentage or so. So, in my opinion, you have to look at each market individually. S&P 500 has a lot of benefits. Banking and oil being the top two sectors within that make up the S&P 500. Banks are going to benefit if you truly believe that interest rates are going to go higher because Trump has a pro-growth agenda and he's going to be able to raise GDP. The interest rates will go up a little, which will benefit net margin for the banks. They'll be able to start finally making money on those huge reserves that they're holding. That'll be a net positive. Obviously, they'll benefit obviously from a lower tax rate as well. Oil companies should do okay considering oil prices are up 100% from where they were last year when they were trading in the high 20s, low 30s. So you're going to get earnings power from the banks. You're going to get earnings power from oil, which are probably the two largest sectors out there. And then if you believe in the infrastructure project that supposedly is going to happen and people are throwing out a trillion dollars or so, that's going to boost industrials and that's going to help out infrastructure plays like Caterpillar and so on, which again will trickle down to more of the smaller cap companies because they're going to have to benefit, especially Trump is pushing a US agenda to make everything that we build in the US. So you're going to see a little bit of a benefit there. Do I think that we're in the late stages of a bull market? Yes. To use a baseball analogy, I don't think we're in the ninth inning. We're probably in the end of the seventh, beginning of the eighth. Like we're getting there. And typically, bull markets end with a exuberation. So if you go back to 98 or 2007, there was these melt ups that you saw right before the crash, kind of against what people fundamentally thought. Some people are saying that that's possibility of what's going on right now with the Trump rally. I don't see it. I think Trump is going to do a lot of pro-business, short-term agenda stuff like tax rates, infrastructure, and so on. That's going to really help earnings this year. And market at the end of the day trades on earnings and a multiple of those earnings. So if he can really bump up growth rate to 2.5, 3%, which he can with a nice infrastructure plan, and there's also animal spirits in the market. People are getting, if you look at the small business confidence, it's at the highest it's been in a long time. So you're finally getting some type of optimism coming from business owners, CEOs, and that means they're going to spend. That typically means they're going to spend because if they feel good about the future, they're going to want to put money to work, and that's going to obviously reverberate around the economy in a positive way, and it's going to push up growth. So I do think you're going to see a bump in growth, especially if you do an infrastructure project, especially if this animal spirits continue, you're not going to get any bumps in the road. So if you could get growth from 1.5 to 2%, like we've had in the last 8 or 9 years, to 2 to 2.5 to 3%, and you cut tax rates so earnings EPS goes up, you'll see the exuberance come in. I think the market could push. I think PE ratios will stay on the higher level. Maybe they'll come in a bit, but since earnings will grow 10, 12, 15%, I think you could see a nice pump in the market for another 10 to 20% this year. Saying all of that, there are negatives that we're not talking about. That trade wars, there's a lot of credit crises in Europe, but other country leaving in the European Union. So there are some negatives and it's one events that can affect this view. But I think the base case is that we're probably going to trade higher based on increases in earnings per share. And I think where you're going to see the real benefit is going to be the small caps in the S&P 500.
Robert, you still there?
Yeah, I'm still here, and I'm interested to note that although the Nasdaq hit a new high yesterday, and the S&P hit a new high. As Gary said, the Dow was kind of the laggard, and I don't know if that's just because it's so big that it moves more slowly. But it had a nice bump up, but it did seem to lag behind the other two, which seemed to jump. Is that just a factor of the size of the Dow, or do you think that it's because it's made up of less high tech, or is it? Why do you think it lags behind the Nasdaq and the S&P on a day like yesterday?
Sure. I think there's actually a good reason for that. The Dow is only made out of 30 components, the Dow 30, and so each one has a lot more weighting than, let's say, the Nasdaq, which is made out of 100 companies, or the S&P 500, 500, or Russell 2000, 2000. So yeah, we're in the midst of earnings season. So when you have a couple of companies like yesterday that announced earnings, I believe it was Verizon, Triple M, and some other ones that had travelers that had a pretty bad day, down 2 or 3%, it becomes difficult for the rest of the Dow to pull that weight out because there's only 25 other ones, as opposed to like the S&P 500 or the Nasdaq 100. When you have two or three companies come out with bad earnings, they might affect the whole entire sector, but still, even if it's 10 stocks, you still have 90 that could take it out. So yesterday, I think the big issue was Lockheed guided down. American Express had a bad earnings the day before. Triple M, Travelers, some of these companies, some of them have a higher weighting in the Dow because they're priced higher. So they were able to hold back the Dow. So I think on a day like yesterday, it could be, you could either look at it as an optimistic way, which is, okay, now those earnings are behind and they're not going to pull back the Dow anymore. So now eventually we're going to get good earnings out of the Dow and it's going to push through 20,000. Or you could look at it pessimistically and say, hey, the stocks have gotten ahead of themselves and the earnings don't justify the move. I think that the market, considering we're at all-time highs, is kind of looking at the optimistic way. So today, let's say when the market's open in the US and you don't have any bad earnings in any of the big Dow members, you should probably see outperformance in the Dow to catch up, to make up a little bit for what they missed yesterday.
I see. So it's I see what you're aiming at. By the way, the FANG stocks, as I remember, are Facebook, Amazon, Netflix, and
There it is.
Google.
Yeah,
And
Netflix.
to tell you the truth, aside from Amazon, I bought all the rest of the IPOs, Facebook, Netflix, and Google on the days that
Spectacular.
went public. Amazon, somebody came home to me on one of those days and said, or into the office and said, this company, there are these two guys are selling CDs online, and it's going to be a great big business. It's called Amazon. Maybe we should invest in it. I said, where? On the internet, they're selling CDs. That's interesting. And that was the end of my interest in Amazon. And by the way, Amazon from there, of course, went to multiples. And in 2001, after the crash, when it was only worth about $8 a share, had you bought the IPO and gone through the whole bubble and still owned it after it went down to a few dollars a share, it was still worth 20 times
Wow.
what
Well,
the
yeah.
original IPO investors paid for it at $90 a share.
Wow. Yeah, no, that's pretty incredible. Actually, I read a story that if you invested $5,000 on the Amazon IPO, it'd be worth $1 million today. So,
Well, the Netflix, I was just looking at that, the original 100 shares that an IPO investor would have bought would have cost them $15 a share in 2003. I think it was May or June 2003. That would have been $1,500. As of last week, that would have been $189,000 for
wow.
an original $1,500 100 share investment.
That's spectacular. Yeah, no, the funny part is I was one of the first users. I didn't actually buy the Netflix IPO, but I was one of the first users for Netflix. At the time, I would go to Blockbuster, and I always had those late fees because they give you 3 days, and then I forget. I take out 5 movies, and every week I'd owe $75, $80, and it was kind of like a consistent thing. And then when Netflix came out, just before streaming, they would send you the CD to your house, the DVD to your house, and they would send you 3. So I had it perfectly set up, the queue, and I said, you know what, this is going to kill Blockbuster. And I didn't necessarily think to buy Netflix. I don't know why. I thought there would be more competition. But what I did do is I shorted Blockbuster, and I basically rode that to zero. I think I covered at 50 cents. It was a pretty good short. Yeah, it was one of the times that I thought, there's this thing on the street that says that if you hold the stock to zero, you don't have to pay taxes on your profits, because the way that the system works is you're actually borrowing the shares, and then you don't have to return it if it goes to zero. So I was really hoping on that, but then I found out since I did it in a corporate section, it didn't matter. So I just said, you know what, I'm going to take my 50 cents and run. But it was a great trade. I shorted it at a decent price, and I think I made over 10 points. I don't remember exactly, but it was a good trade to zero. It was one of the only times that I caught a stock all the way down to zero.
Robert, do you feel like did Gary answer your questions? Do you have any further questions for us?
No, I think that's good insight on what the Dow may be doing today. If there are no bad earnings, and we can look for either another up day, a day, or a sideways day on the comp of the S&P, but definitely the Dow. If the news is just normal, regular news, there's no spectacular bad news. It looks like it's going to be a couple more days, weeks, or months of fairly good indications and fairly positive news on all three indexes.
I do want to mention a couple of things, couple of caveats, because I mentioned kind of a longer term. I think on a shorter term basis, I just want to mention a few things. Technically speaking, I think all three indexes, but specifically the S&P 500, we had a potential bull flag for the last 2 or 3 weeks. We've been in a very tight range, consolidation range. A lot of people that's typically a good sign for the bulls. If the bull flag does play out, you have another decent move up. You basically take the flag, which is from the November lows, which is the pre-election lows, and you take the entire Trump rally, and then you take that move and connect it to the bottom of the bull flag, which was, let me look here, which was on the S&P 500, 2233 roughly. So you're looking for a nice expansion move on the technicals if that plays out. The one thing that I will say though is that it might be a false breakout here. So I like the move yesterday that it was done on volume. You're 100% right. It didn't quite break out of the tops because so you had these tails. If you look at candlesticks on the S&P 500,
Exactly. Yeah.
you have these tails that were kept going into the 70s and then
Mm-hmm.
closing in the 60s.
Mm-hmm.
And you closed above that 60 level, so you had an all-time high close, or you had a higher close than the bull flag, but you're still within the tails of those candlesticks. So now I'm not predicting that we're going to fail here. I'm just saying that it's a possibility that this was a false breakout. There is an M pattern developing on the daily of the S&P 500, which if that ends up playing out, will take you back down to around 2100. You did have a doji on the monthly for December on the S&P 500 as well. So typically dojis, they're showing you that the market will pull back. So they're kind of contradictory signals here. Again, longer term, medium term, I think we do end up going higher. I just want to be cognizant about the fact that just because we broke out, had a potential breakout yesterday, doesn't mean we need to confirm it today, basically. The way that I always trade is I trade in a 2-point system. You have the breakout, then you need the confirmation. Very rarely do we just break out and just go. I mean, it happens. I'd rather miss them. I'd rather be more confident with the confirmation. So I am looking for the confirmation today. See how we hold probably the first half of the day. If we hold strong or continue, the breakout, obviously the breakout is on. You could see a move to, what is it, 21. You could see another 100, 150 points on the S&P 500 in over a few weeks or maybe a month or two. February, there's this concept of cycles. So there's strong month for the market, weak months for the market. It's not something that I follow really strongly, but it's just good to be cognizant. February is the weakest month out of the strong months. So we have May till October is considered a weak period for the markets. That's why I'm sure you've heard of sell in May and go away. Typically, the market pulls back in this time frame, so that's considered the weakest 6 months of the market. And then the strongest 6 months of the market is October till May, till end of April. So within that strong context, February is typically the worst month, the weakest month. So considering we're here at the end of January, considering we had a doji on the monthly of the S&P 500 last month, considering that we do have a potential M pattern here at the top of the market, or double top, like other people like to call it, there's a reason to pause and reason not to be super optimistic, but let's see how it plays out today. Let's see if we get some type of continuation of the rally yesterday, or was it just let's get everybody into the market long. Market is, poised to gap up a little bit today. We have that, and then all of a sudden the bears come in and they crush this market, and all those weak longs that got in towards the end of yesterday and in the morning today get absolutely shellacked. So we need to pay attention to that. As long as we hold, I feel like above that 2260 level, 2260 to 2270 level on the ES that we've been stuck in for 2 weeks, I think we could see a potential breakout and easy trading to the upside. And if not, we'll catch it to the downside. But just be cognizant of the fact, like, let's not go all in here, considering there are some negatives out there, technically speaking.
Gary, thanks so much for your time. Robert, thanks for your questions. This is Amos here again with Gary, head trader at SizeTrade. Thank you so much, both of you.
Thanks. Thanks a lot, guys.
And we'll be